Petroleum National Berhad. So basically, Petronas is given the power to for the ownership and exclusivity of the petroleum activities. So the rights and ownership are given or vested under Petronas. So if let's say you have an area, for example, you have an area in Malaysia that that has reservoir hydrocarbon, and Petronas said, okay, they want to award this particular area to a particular PSC contractors. So Petronas has that right, and Petronas will sign a production sharing contract with that particular company. A PSC production sharing contracts will stipulate what are the rates or what are the sharing of activities or sharing of profits inside that production sharing contract. Okay, so petroleum-related legislation that usually we refer to during my day-to-day work would be these two: Petroleum Income Tax Act 1967 and also Petroleum Development Act 1974. So your PDA usually, those mentioned in the PDA are the asset are vested under Petronas. The rights are vested under Petronas, and also the payment of royalty or special payment to the government would be under the PDA. So for Petroleum Income Tax Act, it is more on the activity itself, the petroleum operation, how you tax the petroleum operations. So it's akin to our Income Tax Act 1967, where Income Tax Act, you tax on income of a company or a person in Malaysia, or derived income in Malaysia. But for Petroleum Income Tax Act, it's more on petroleum operation. Okay. So other than that two main legislation, we do refer to these legislation and guidelines. We have Income Tax Act 1967. We have RB Public Ruling and Guidelines, your PIA, your RPGT Act, Stamp Act, Double Taxation Agreement, and for indirect tax, it would be Sales and Service Tax, which is came into effect 1st September 2018. And for PITA is more on your PITA, your Petroleum Income Tax Act, and also IB Public Rulings and Guidelines. Okay, second part would be the salient features of PITA. So when I said salient features of PITA, I won't be going through the whole book of PITA or the whole act, but what are the important sections or features that you need to be aware of when you are doing upstream activities or petroleum related industry. So, first of all, you need to determine whether your activity would be taxed under Petroleum Income Tax Act, PITA, or Income Tax Act, ITA. So, if Petroleum Income Tax Act, the activities from exploration, development, production, decommissioning, and also transport would be fall under Petroleum Income Tax Act, where we define it as upstream activities. So the rest of it, where you do have transportation, refining, marketing, and distribution, it will fall under Income Tax Act, where you will be taxed under the normal ITA lah. the company itself. So when I say transportation, transportation is not only transportation vehicle by vehicle, but it also meant by pipeline, because you are delivering crude or gas. Usually it will be based, you will use pipeline as part of your transportation to your refinery or to your plant, right? So basically, the transportation would fall either in upstream activities or downstream activities. Determining factor is your point of sale. So transportation within Malaysia to any point of sale or delivery or export would falls under upstream activities. But if it's after any point of sale or delivery or export, then it would be under ITA or normal downstream activities, and it tax under ITA. So usually for tax purposes, when a particular project is being made or is being assessed, we will ask the so-called project team, how do you evacuate the hydrocarbon? Is it by is it by pipeline? And if it's by pipeline, where is your point of sale? So if the point of sale is at the beginning of the pipeline, then you can't claim. The rationale is it is not an upstream activity after the point of sale, so you can't claim capital allowance for that particular pipeline. I'm sorry if I'm using technical terms. Forgive me, because for tax practitioner we usually will use technical terms loosely. Let me know if, let's say, you don't understand or you need me to explain further. Then I will try to use as layman as I can. Okay, so the next important terms inside PITA, Petroleum Income Tax Act, is what is petroleum, what is Malaysia, what is petroleum operations, what is your chargeable person, separate chargeable person, continuing partnership, and contiguity. All these so-called terms are very important when for upstream industry or petroleum industry, as these are the determining so-called factor and also criteria for you to ascertain your chargeable income for under Petroleum Income Tax Act, under PITA. So bear in mind, I will explain the so-called each of these in the next slide. Okay, so what is petroleum operation? Imposition of tax. What are the criteria for a tax imposition? Basically, for how do you tax an income of a particular company, whether it is under PITA or SITA? This is the so-called factor or criteria that you need to be ascertained before you determine, oh, okay, this income is under PITA, it's not under a normal IPA. So one thing is whether the activity are you doing, the company is doing is petroleum operations or petroleum operations related activities. And also whether the activities are done in Malaysia. Okay, so if you combine both if a particular company is doing petroleum operations in Malaysia, then it will be taxed under PITA, Petroleum Income Tax Act. So this is the crucial part, similar like IDA. Your scope of charge, it would be income derived in Malaysia. Basically, for income derived in Malaysia, you will be taxed in Malaysia. So similarly for PITA, for any petroleum operations derived from a Malaysian territory, then it will be taxed under PITA. Okay. The definition is in the Act. This is a snapshot of the definition of petroleum operations. So we have here, searching for and winning or obtaining of petroleum in Malaysia by or on behalf of any person for his account or on a joint account with any other person by any drilling, mining, extracting, or other like operations or process in the course of a business carried on by that person engaged in such operations and all operations incidental thereto, and any sales of disposal by or on behalf of that person of petroleum sown or obtained, and includes the transportation within Malaysia or on behalf of that person of petroleum sown or obtained to any point of sale or delivery or export, but does not include transportation of petroleum outside Malaysia, refining and liquefying of petroleum activities, dealing with products so refined. So basically, once you have refined, then you do trading. Service involve the supply and use of rigs, derricks, ocean tankers, and barges. So basically, all these activities, item 1 to 4, are not falls under petroleum operations. So if let's say, for example, you guys have heard about Schlumberger, other service provider or in oil and gas industry, they are taxed under ITA, not under PITA, because all these 4 items are not regards as petroleum operations. So item B, in nutshell, for this A and B is similar to the one that I've shared before. Okay, in nutshell, all these activities are upstream activities and tax, and petroleum activities and tax under PITA. So if it's after the DP, then it will be after the delivery point or sales point of sale, then it will be taxed under ITA. So here they say to any point of sale or delivery or export. Okay, so it's up to the point of sale or up to the delivery point. Okay, so next would be what is petroleum operations and what is not. I think this is just to make it glaring or clarify it further. Searching for and winning or obtaining of petroleum in Malaysia is more on the activities that you do in exploring, exploiting the hydrocarbon in Malaysia. So those activities are under petroleum operations. So the next one is the sale of the hydrocarbon or petroleum that you when it says one, is the one that you you extracted from the ground, any sales of that hydrocarbon would be subject to PETA and regarded as petroleum operations. So the next one is transportation within Malaysia of petroleum solvent. So basically, as I mentioned, transportation here is not only vehicles, or is more on mode of transportation, where you have pipeline, you have, when you want to transfer or evacuate a particular crude or gas, it will be via pipeline. So pipeline is also a part of transportation. The next one is transportation of such petroleum within Malaysia to any point of sale. So basically, transportation before the point of sale would be under PETA, but after the point of sale or delivery point would be under SITA. And it excludes transportation of petroleum outside Malaysia. All these are I have explained just now. So basically, anything with regards to petroleum operations, then it will be taxed under PETA. Okay. I hope that my explanation is not like convoluted like the picture does. Okay. So next would be, who are the chargeable person? Okay. For ITA or Income Tax Act, your chargeable person is a person where is liable to pay tax, right? It can be an individual, it can be a partnership, it can be a company. But for PETA purposes, it specifically the definition of chargeable person specifically stipulate or states that the chargeable person is PETRONAS, is Malaysia-Thailand Joint Authority, and the third is, in relation to each petroleum agreement, any other person carrying on petroleum operation. So for item 1 and 2 is a company by itself. Petronas and MTJA is the so-called regulatory of hydrocarbon or petroleum in Malaysia. Number 2, Malaysia MTJA, Malaysia Thailand Joint Authority, was set up between two governments, which is Malaysia and Thailand, for an area, joint dedicated area between Malaysia and Thailand. It's near to Kelantan and Songkla, not Songkla, Rauyong. So the reservoir were, both countries agreed that, okay, they will jointly so-called develop the area. So to govern that particular area, authority so-called akin to Petronas has been set up or developed. We call it MTJA, Malaysia Thailand Joint Authority. So the third so-called chargeable person is the most crucial for petroleum activities or petroleum contractors, where the filing or the tax would be charged to a petroleum agreement. So when we file tax return, it will be tax return by the Psc. Petroleum agreement in my example previously is production sharing contracts, right? For the production sharing contracts is the agreement that we sign between Petronas and also the companies lah, the oil and gas company. So we have Carigali, Petronas Carigali Sunita Berhad, we have Shell, we have Exxon, we have ConocoPhillips, we have Murphy. So all all these companies would sign a PSC, production sharing contracts with Petronas, and that PSC would be chargeable, is regarded as a chargeable person. So you file tax return based on that PSC. Okay, so the section, the other section that we need to be mindful is ring fencing. So in PETA, each PSC is considered as a chargeable person, right? When we say a chargeable person, so you file a tax return based on your PSC. But for example, for Charigali, so basically, when we say a chargeable person is a PSC, so the filing would be done or tax return would be submitted by the petroleum sharing contract, the PSC itself. So kalau let's say for example the upstream arm of Petronas is Petronas Charigali Sdn Bhd. For Petronas Charigali has signed like 160 PSC. So PCSB, Petronas Charigali Sdn Bhd, is not going to submit one return only, but the company has to submit 160 PSC tax return by virtue of this ring fencing. So you can't so-called consolidate your PSC. But there are certain exemption or incentive were given. I will explain in future, in next slides. So for this example, right, under PETA, you have PSC A and PSC B. So you file two returns. If CP Sdn Bhd, for CETA, the other two, they have two, the company has two business, one is shipping, one is property, but they still file in one return, but they segregate so-called the income tax, the tax computation. So this is the difference between PETA and CETA. You are not filing based on company, but your filing would be based on your petroleum sharing contracts. Okay, for example, right, if let's say Charigali has a partnership with Shell, right, and Shell and Charigali sign a PSC with Petronas. So the filing for Petronas, Shell and Charigali, Petronas, because Petronas is a chargeable person, so Petronas will file the tax return based on the company per se. But for Charigali and Shell, they will file PSC tax return, and the tax computation prepared, it will be separate, segregated between Charigali, PCSB, and also by Shell. So the total, and then you will so-called accumulate or total it up, and then file a tax return as one tax return. Okay. I've spoken about the ring fencing. This is one of the so-called incentive or allowance that government has given to us, which is contiguity concept. Contiguity concept where you have the ability to combine two tax returns for neighboring PSCs. Similar to CETA, you have few business operation or business source, then you file in one return. For this contiguity, it's also the same. You treat it as one chargeable person, so you have PSC C and PSC D as one chargeable person. So you file only because your return would be filed by chargeable person. So you file one return for both PSC. But there's a condition for this, there is a condition for the PSC to be contiguous. One is the partners in PSCD and PSCC are the same partners. Okay, the partnership are the same partners, and then the second one, the area PSCC dengan PSCD touching to each other. So there's one particular area like here, here touch to here. So it touch with each other, then it is not an automatic so-called contiguous. When you want to apply for contiguous, it's not an automatically decision, but you need to submit to Inland Revenue Board, LHDN, and provide the proof that okay, this PSC and this PSC has the same partners, and both PSC, the area touch to each other in one point. Okay. So when you file, when RV has approved, then you file in one return instead of two separate returns. Okay. So the next one is continuing partnership. Continuing partnership is more on when we say the terms that I will be using is farm in, farm out, where you transfer your participating interest or your so-called partnership lah, to another company. So why continuing partnership is important? This is because you remember that we file in one return. So the chargeable person is the PSC, and if let's say you do not have continuing partnership, so the chargeable person would be lapsed, and you would forego all the tax attributes or tax benefits that you have in that, in the previous chargeable person. So in order for you to maintain the tax attributes or tax benefit, you need to ensure there is continuing partnership, which is under section 2.2 or 2.3 of PETA. So, if we can see here, the example here is PCSB, Alpha Co and Beta Co sign are the PSC contractors for Block B. So Block B is the PSC's name lah. Okay, so I think 2 or 3 years down the line, Alpha Co and Beta Co dispose of their interests to ABC Co and XYZ Co. The criteria for you to achieve this continuing partnership is at least one original party is a member of both PSC. So, one original party, in this example, PCSB is, still remain as the party of the new PSC. And I don't call it new PSC on the so-called partnership, right? So, for this example, it meets the criteria, continuing partnership criteria. So, whatever tax attributes under Block B, you can continue to claim. You can continue to claim under Block B, the new partnership. So basically, the reason why we would like to maintain is you have capital allowances balances, you have losses balances, you have QEC balances where you can use for future set off to for the future income. Then you can use it. You can continue to use or utilize that tax attributes. Okay, so if let's say there's no continuing partnership, if let's say 3 parties and then PCSB also farm out, sell off its interest, then there's no continuing partnership and a new chargeable person has been created. When I say new chargeable person, so you will start from zero lah. From the day you transfer, then that day onwards, you will start claiming or uh, uh, reporting your income or expenses as zero from that onwards. Okay. So these are the rates. We have been in 38% bracket from 1998. I don't think there's any news for reduction in near future. But it's still a lower amount as compared to other PSC or other countries. I've seen 60%, I've seen 40%, I've seen 55%, which is more than what we have. But I've seen lower as well, 30%, but other countries or jurisdiction has had other incentive or other tax rates. It's not across the whole world. Okay, so this is a serious matter. Now is how do you ascertain your chargeable income? Okay, similar to ITA, chargeable income, I think the flow would be the same. It's just the difference would be your basis period. Okay, your basis period for PITA, it starts from when you first sale of your hydrocarbon. Then you will start your basis period. So from basis period onwards, you will pay tax lah. But prior to basis period, prior to your first sale, the so-called reporting is more on reporting your expenses as compared to reporting your income. So your basis period kicks off when your first sale, and then there is the point that you will be starting claiming all the expenses and also all the so-called income being taxed from starting of basis period. Okay, so chapter 2, part 3, chapter 2, section 6 to section 14 of PITA talk about your so-called income which would be subject to tax under PITA. Okay, your allowable deduction. This is similar to similar to section 33, 33, 34, and your second schedule of your ITA. So similar wordings and also, but there is some specific for PITA under section 16. Okay, when you have gross income, then you deduct your allowable deduction and then you get your adjusted income or adjusted loss, which is under your section 15 or 16. And then when you have your, when you ascertain your adjusted loss or adjusted income, then you less your capital allowances is under second schedule. So after that second schedule, after you deduct your CA, your capital allowances, then you have your statutory income. So to reach your chargeable income, then you have donation or set off or against your other income. This is to derive with your chargeable income. Okay, it's similar to ITA. The only different, I think, is the starting point, the basis period from ITA is different. Okay, So as I mentioned, exploration period versus basis period. So if let's say production stage is where your first hydrocarbon sold, then this is the starting point of your basis period. So the filing of, as I mentioned, the filing of prior to your first sales is during your exploration period would be accumulation of your expenses, and you can only claim those expenses after you kickstart of your basis period. So the form to be submitted is Form CPE and Form CPP, which I will also touch on this in the next slides. Okay, would be I because I have another 1 hour, so I will be touch the important points of PETA for the. I will share this slide with Dr. Sami. So if let's say you have any clarification in future or later, you can email me or you can let me know, let Dr. Sami know. Okay. So because this is one way, okay, this is the so-called case study or quiz that just for you guys to have a look. And then if let's say you can give me your answer in the chat room. So background, okay, PSC A and B has been awarded to co-hasil and co-tax. However, within the GOA of PSCB, it stated that deja vu field is 100% owned by co-hasil. So, can deja vu field be a chargeable person? If not, who is the chargeable person? So, deja vu field is here. The PSC is here. Block B and Block A is PSC A and PSC B. But deja vu field is under PSCB is the co-hasil would be the so-called 100% own the field, okay, which is part of PSCB. So can deja vu field be a chargeable person? So for these purposes, for deja vu field, as I mentioned, for a chargeable person, it has to be a petroleum agreement. So, deja vu field, there's no petroleum agreement signed for deja vu field. So, it is just under the GOA, right? Joint so-called GOA is the joint agreement between the co-hasil and co-tax, where Petronas is not a party of that agreement, so it won't be regarded as petroleum agreement. So, deja vu field for this question, deja vu field is not a chargeable person. So, the chargeable person in this example is PSCB and also PSCB. Okay. Okay. Part 3 is phases of upstream life cycle and related tax implication. So as I mentioned just now, in earlier slides, under upstream, we have exploration, development, production, and decommission. So all these related activities are under petroleum operation, and I'll go through each phases and see what are examples of expenses and whether it's deductible or not deductible. Okay. So exploration phase, okay, during exploration phase, the deduction or the accumulation of expenses during exploration phase, it falls under section 16.5 qualifying exploration as expenditure, where you will accumulate so-called the expenses, and then the claim of that particular expenses would be made after your basis period. So the based on first schedule, qualifying exploration expenditure is under first schedule of PETA. First schedule is exploration expenditure. Second schedule is your CA. So for first schedule, you have acquisition of petroleum deposit or rights. If you've made any payment for acquisition of petroleum deposits or rights, then it will be you can claim as QEE. You can accumulate the cost and claim as QEE, qualifying exploration expenditure. So if you have searching for discovering, testing or winning access to petroleum deposit, this is more on you have seismic studies, you have GNG, all these are covers before you manage to extract the hydrocarbon. You do the testing, then that testing or that particular survey would be allowable for deduction under QEE. Okay. Construction of work or buildings of little or no value. This is more on your platform, your temporary platform, your temporary rig, so-called well, would falls under this. Okay. Development or G&A or management before sales or disposal of petroleum. So this is all other related expenses that you incur. Your G&A, your salary costs, the company's rentals, your interest expense, your what else? Your management fee, whatever expenses that you incurred relates to petroleum operation would falls under here. Okay, you will accumulate, as I mentioned just now, you will accumulate all the expenditure here, and then until production stage, then you will claim that particular QEE based on this rate, which is IA. IA is your initial allowance, similar to IDA. Initial allowance at 10% and 20%. 10% is for primary, secondary 20%. For AA is annual allowance. Annual allowance is based on reducing balance, higher of 15% or percentage of ratio calculated using the prescribed formula. This I will touch in next slide. Okay, these are the so-called calculation for allowable deduction under first schedule, your qualifying exploration expenditure. It is an depletion allowance. You split into IA and AA. So IA, whether it's primary recovery or secondary recovery. So it depends if primary is 10, secondary is 20. So for AA, it's greater of 15% or fraction of based on output over output plus your so-called potential reserve in that particular field or Psc. So usually if it's towards the end of a particular Psc life, then this we will use this formula because your output will be like less than this amount. If not, it will be 15% reducing balance. Okay, so apart from that, under exploration phase, you have incentive where you can transfer your QEE to a producing PSC. So one thing is you need to have same original parties to transfer the QEE, and and you can only utilize in production PSC, not exploration PSC. So exclusion for this particular para 3A or first schedule is for JDA or overlapping areas. You are not going to so-called, you can't apply this incentive or transfer of QE. Okay, the next one, it would be development and production. So the same, how to ascertain your chargeable profit or chargeable income is the same. So I will skip this. So, okay, in determining of income, right? Similar to ITA, you need to see or distinct between capital and revenue. If it's a capital receipt, then it is not taxable. If it's revenue receipt, it is taxable. So what do you call it? I mean, how do you determine whether it's a capital or revenue? Okay. Usually, if it's if it's clear cut, right? If it's clear cut, if it's selling of hydrocarbon, selling of crude or selling of gas, it is a clear cut. It is revenue in nature and tax under PITA. The one that I think you think that it is whether you need to determine whether it's a capital or revenue for upstream industry or petroleum industry is more on your compensation, your insurance, payment other than income or payment that you receive other than your selling of your hydrocarbon. So for basis of trade, you need to determine whether that particular income is revenue or capital. If it's whether you fulfill this profit-seeking motive, the way the asset is secured, subject of realization, modification of the asset, length of period of the ownership, the way sale is secured, frequency of similar transactions, trading interest in the same or similar field, method of financing. So all these are the basis of trade that usually we will look at to determine whether a particular income or receipt or consideration is capital or revenue in nature. Okay. So these are the examples. If it's a profit-seeking motive, profit from sale of land, whether the land is, you are in property activities, a company, then when you sell of land, it will be a so-called profit-seeking motive where you are in the business of property, right? The way asset is secured, whether it's an asset was purchased or inherited or received as gift, okay, subject to realization. So whether it's for personal use or trading stock, if it's, one thing is your accounting, accounting disclosure, whether your asset is put under, disclosed under stocks or under your long-term asset or your asset, right? So modification of the asset, whether you do modification of that particular asset or, when you derive that income by way of selling something, whether you do something, modified something to that particular asset. Okay. Length of period of ownership. Okay. For property purchase as investment, usually you will hold it more than 5%, 5 years. So if it's less than 5 years, then if it's a recurring or less than 1 year, then you can argue. IB can argue that you have this revenue, this income is revenue. The way sale is secured. So whether the sales are campaigned by advertisement or employment of sales staff. I mean, you have motive. You are marketing that particular selling of that particular items to derive that income. So frequency of similar transaction, whether it's recurrence or is once off item transaction. Okay, trading interest in the similar or same field, whether you are selling or the income derived from incidental to your business. Okay, method of financing. How do you get that so-called income from and your business? What are the financing that you obtain for your business? Okay, so as I mentioned just now, first you need to determine whether the income is revenue or capital. If let's say once you have ascertained that the revenue is the income is revenue in nature, so these are the sections in in PITA, where you need to park your income lah. So you have section 7, section 8, section 9, section 10, section 12, 13, 13A and 14. So section 7, 8, 9, 10 and 12 is more on the selling or transferring your crude or your hydrocarbon, and the income that you receive would be subject to tax under PITA. So section 7 and 12 is more clear cut, as I mentioned just now. The one that is might be so-called that you need to further investigate is section 13, 13A and 14. Okay, miscellaneous receipt. If you have, you receive any income, whether you have to determine one thing is whether it's revenue or capital. When it's revenue, whether it relates to PO or petroleum operation or not. If it relates to petroleum operation, so section 13 kicks in, then you will tax the income under PITA. Okay, so section 13A. Let me see whether, okay. Section 13A is more on taxing of income or disposal value of asset which is being disposed by the Psc contractors. So when section 13A is to tax Petronas, as I mentioned earlier in my earlier slide, PDA vested asset, ownership of asset and also rights to Petronas or MTJA. But for section 13A, all asset under PSC contractors or PSC are asset of Petronas. So any disposal, Petronas will be taxed for that particular income that the PSC contractors receive, and it will be taxed under Petronas book, because the PSC contractors are not the legal owner of that particular asset, but it's more on beneficial owner of a particular asset. Okay. Section 14 is more on sums recovered on accounts of debts and debts release. So if let's say you have bad debts and you have accrued bad debts in your accounts, and suddenly you manage to so-called collect that bad debts, so debts would be subject under section 14. The income that you receive from that would be subject to tax under PITA. Okay, so I've covered income. Now it will be expenses. what are the expenses which is relating to petroleum operation or petroleum industry that is deductible under PITA. So the sections for deduction is 15, 16 and 17, which is akin to your ITA 33, 34 and 35, right? Okay. So the main, most important uh, general section is section 15, which is your section akin to section 33 one. It has to be outgoing expenses wholly and exclusively incurred in the production of gross income. So basically, if you have expenses under petroleum operation and it fulfills these four criteria, then you would be able to get tax deduction on that particular expenses. Okay, criteria number one is outgoing and expenses. So outgoing has a wider meaning than expenses. It refers to your accounting transaction where you have losses due to theft, bad debts, cost of free samples, specific bad debts. So all these are not outgoing. Are not expenses that you incur, but it's an outgoing for your company, right? So, and for expenses is any cash outlay or payment of money for that particular transaction. So, the first criteria is outgoing and expenses, whether a particular amount that you spend is outgoing and or all expenses, right? Okay. The criteria number two is wholly and exclusively. So wholly refers to the quantum of the expenditure. So you would need to demonstrate that you use or you incur that particular expenses totally for petroleum operations. Okay, exclusively refers to the motive, purpose behind the expenditure. So if the expenses incurred based on your petroleum operation and exclusively, you will meet, you certainly will meet exclusively criteria. Okay, criteria number three is incurred. Must be incurred in the basis period, not a provision. Refers to the case where a defined liability to pay has arisen, excludes anticipated or provisional expenses. So when we say incurred, is you are liable to pay for that particular expenses, okay, and it's not a mere provision or without any basis. For any mere provision without any basis, then it won't be tax deductible. Okay, criteria number four is provision versus accrual. Okay, this is an example for incurred, right? So the criteria number four, whether it's a provision or accrual. So for provision, you have no liability to legal liability to pay. So if you don't have any legal liability to pay, then it's not tax deductible. But if it's an accrual where you have signed an agreement with a particular contractor or particular vendor, and the services has been rendered. So when the services has been rendered, but you have not received so-called the invoice, but you can demonstrate that based on the agreement that you sign, where once the services has been rendered, you are liable to pay for that particular services, um, even though you have not received the invoice, then it will be an accrual and it will be a deductible expenses. Okay, criteria number 5 is in the production of gross income. So in the production of gross income is more on whether the expenses is incurred for the production uh, the hydrocarbon or the crude or the relates to petroleum operation. Okay. So um, these are the tests that you need to, I mean, usually when you do tax computation, you need to ascertain whether it meet all these tests, and then if that's the case, then we can claim tax deduction on the expenses. Okay, distinction between capital and revenue expenses. So if it's capital expenditure, similar as capital income, is not deductible. For capital income, is not taxable. For revenue expenditure, is deductible. Okay, so the test similar. I mean, for test for expenses is once and for all, enduring benefits, identifiable asset, fixed capital versus circulating capital, business entity. Okay, I think I will touch the few tests, once and for all tests, whether it's recurring or is this once off punya payment. So enduring benefit test, whether you create any advantage or benefits to the company by incurring that expenses. And fixed capital versus circulating capital test, whether what the owner turns to profit, if it's in is it capital or it's fixed asset or it's stock in trade. Okay, so allowable deduction under section 15 for PETA, it has to fulfill expenses incurred wholly and exclusively in production of gross income. And for repair and maintenance, if it's the life cycle, working life is less than 2 years, then you can claim a deduction. If more than 2 years, then you will claim capital allowance. For interest expense, assessment rates, rent payable would be deductible under section 15. Okay. So these are the rates, the sections. Okay. Okay, section 16 is more, the highlighted one is more peculiar for PITA. The rest are similar to ITA, Income Tax Act. So you have capital expenditure on exploration. This is your first schedule, your QEE just now, exploration expenditure. Your cash payment on petroleum ward, this is your royalty, your Psc payment would be under this. Your intangible expenses for drilling, exploration, appraisal and development wells, special deduction is given under section 16 for intangible expenses for drilling. Okay, so these are the sections, related sections under 16. Okay, section 16.3, similar to ITA, the maximum rate for employer is 19%. Okay, this is IDC. IDC is intangible drilling expenses where we claim tax deduction, revenue expenditure. So non-allowable deduction under section 18 is akin to section 39. So these are the activities or expenses which is not deductible. Usually we will be more careful on expenses for which withholding tax are not paid. Where if let's say you engage non-resident and you have not paid the withholding tax, then you will be, can't claim the tax deduction on the expenses that you incurred for that particular transaction. Okay. So these are the section. Okay, I still have more to go. Okay. So there's a new section 18(1)(a). If no documents provided to IRB, then no tax deduction will be given. So during audit, if let's say IRB requested for documents and you not be, I mean, the company not be able to produce that particular document requested, then IRB has the right to disallow the expenses. Okay. Okay. PSC One Malaysia prepares its tax com. This is an example of workings, right? So both income expenses are taken on accrual basis to determine whether the tax treatment above items are correctly reflected in the tax computation to provide relevant sections and rules regulation. So I think I will skip this. Maybe you can, participant can refer to previous slides and then do it by yourself. Okay. So capital allowances. Capital allowances, for those yang still not familiar with tax terms, so capital allowances under taxation terms and accounting terms, kalau if let's say you have cost of sale, in tax term we call it qualifying expenditure. For depreciation, we call it capital allowance. I mean, the treatment is the same. For net book value, is tax written down value, TWDV. Okay. So basically, when we do tax computation, these are the most important item that we need to be aware of. What is the qualifying expenditure for an asset, and how? What is the rate for the CA? And what is the balance or tax return of value for that particular asset. Okay. So qualifying plant expenditure includes, similar to ITA, includes existing alteration of existing building structure, installing machinery or plants. And if let's say you do so-called preparing of site, is not exceed 10% of that particular machinery or plant, then you can qualify as QPE. And this is special or peculiar for PITA, where construction of fixed offshore platform for drilling and other petroleum operation. Okay, the criteria. So you have to fulfill incurred, own in use, IOU. So when you fulfill these three criteria, then you can claim CA. CA is initial allowance and also annual allowance. Okay. So the initial allowance as per PITA and annual allowance as per PITA is as follows. So fixed offshore, you don't have initial allowance, but you have annual allowance. So for IT, it's the same as ITA. For environmental protection equipment, this is a special gazette order. Plant machinery, for ITA you only have one, but for PITA you have two, normal and secondary recovery. When we say secondary recovery is where a particular field, it has been drilled or it has been extracted before, and subsequently Petronas award that particular field to another party, and to use so-called technology, extra technology to extract the hydrocarbon. So that would be secondary recovery. Okay. Building is your IBA, industrial building allowance. Okay. So QPE, the disposal, what you need to be mindful for any disposal. As I mentioned, Petronas will be hit for any disposal where the proceed would be taxed under Petronas. But for PSC contractors or the company, as asset vested under Petronas. So under second schedule of PETA, because of asset is vested under Petronas, your sales proceed will always equal to zero. So when it equals to zero, right? So you will trigger your balancing allowance, right? So here is the illustration. You have revenue and you have allowable deduction and derived to your adjusted income. And then you have your CA, your capital allowances. So you have your brought forward CA, balance brought forward, your current year claim, your balancing allowance, less your balancing charge. So when you sum up the capital allowance, so you less up against your adjusted income, then you will derive your statutory or your chargeable income. Okay. So these are the control transfer scenario, where in control transfer scenario, you do not compute your BABC, your balancing allowance or balancing charge, and Petronas won't be hit by the disposal value because of this control transfer provisions, where the transferor, when they transfer to another PSC, that the transferee will claim the balance of tax written down value available and continue claiming the CA based on the CA rate and to the balance of tax written down value. Okay. So there's no tax impact if, let's say, you do a control transfer of asset between PSC. So these are the scenario. I think you can read it later. Example. Okay. The last would be under the 4 phases is decom. So what is decom? Decom is when you have ended your so-called activities, and as part of your PSC obligation, you need to so-called restore the area back to its original condition. So it has to be in accordance with good petroleum industry practice. So there is so-called guidelines what you need to do, right? So generally under Malaysian PSC, contractors are responsible for carrying out the necessary work in connection with the removal, proper disposal or salvage of any petroleum facilities such as platform, artificial structures and wellhead equipment that are no longer usable or no longer required. So examples of decommissioning expenses are as follows. So we need to determine whether all these are deductible or not. If it's towards the end of your PSC life, you do not have any income per se. So it will be sunk cost if you incur all these expenses because you don't have any income to set off all these expenses, and you can't so-called going backward the expenses, carry backward your expenses to prior years, because Malaysia we do not have that provision in Malaysia. So that's where for project team or for Petronas, for any PSC that are towards the end of its life cycle, then we will need to so-called plan what are the abandonment or decom activity that that particular PSC would be doing. Okay, so item 4, section 4, agenda for today is overlapping claim area. So, as I mentioned, we have JDA, where dekat sini. This is your chart. Here, okay, here, this is your JDA. So, it's in between Thailand and Malaysia. Okay, so these are the fields under JDA. So, for PSC, you have PSC Block B 1701. Block B 1701 is this whole area besar ni. So you have block B17, block B17 is here. Block A18, block A18 is the yellow part. Okay, all these are block A18. Okay, so the second one is your overlapping area is Vietnam and Malaysia. And we have this commercial arrangement area, PM3 CAA. This part here is Vietnam territory, and here is Malaysia territory. So I mean, we have one with Vietnam and one with Thailand. Okay. Okay, overlapping regions. What is the tax regime? For, I mean, it's a different regime. For JDA area, your income tax, you file tax return in both jurisdiction. So basically, I mean, the company that hold the PSC is PCJDA. PCJDA will file two returns, one in Malaysia and one in Thailand for that particular PSC. Okay. So go back for PM3CAA. PM3CAA, the arrangement, the PSC contractor only file one return, which is in Malaysia, but you split the 50-50 between both countries. Okay, so here is the quiz. You can try whether, I mean, you can base on my previous slides and try to answer this. Okay, PITA incentive, not to say recently, but it was announced in 2010, November, where under petroleum industry, the government has introduced incentive. You have here you have marginal fuels and also investment qualifying projects. Okay, so the difference between marginal fuels is your rate will be different. Your rates, your marginal fuels, you need to fulfill for crude. Your barrel, your reservoir is not more than 30,000 barrels, right? So basically, your rates, this is an incentive that the government give, because no one would like to so-called proceed with the activity for marginal fuels, because the income or the revenue received from that would be small. In order for them, for the government to incentivize the PSC contractors, the government has agreed to reduce the tax rate. So it is, I mean, the tax rate is reduced to 25% instead of 38%. So a reduction of 15%. And apart from that, the higher or accelerated allowance CA is given. For initial allowance is 25, or annual allowance is 15. This is for marginal fuels, right? For qualifying project, These are the qualifying projects, and there are criteria under these qualifying projects where you need to fulfill. The submission of that qualifying project need to be, the application need to be submitted to MOF for approval. Okay, what you get if, let's say, your qualifying project approved by MOF, Ministry of Finance, you will get an extra 60% of allowance, investment allowance, to claim against your income for the qualifying expenditure of qualifying plan expenditure that you incurred for that particular year. Okay, but the 60% of allowance is restricted to 70% of your income, statutory income. So if, let's say, you have income of 100 million, and then you have this allowance of 80 million, right? So the maximum that you can claim against your 100 million income is only 70 million. And the balance of 10 million, you can carry forward indefinitely. Okay. Okay, so this another incentive is the QEE. I think this I've covered previously. Okay, so this is the QEE. Okay, so now is the, not my last slide, I think. Okay, administration. So basically, what is the compliance cycle for under PITA? Is it similar to ITA? So the first one, registration. So when you sign, when a particular company sign a PSC, production sharing agreement, then you need to register to the IRB, to the Inland Revenue Board, to get your registration number. And then the annual filing for PITA is similar to ITA, is 7 months. And currently we are on e-filing mode. So for e-filing mode, there is an extension given, grace extension, grace period given for 1 month. So you can file for the tax return by August 31st August 2020. But due to current condition, COVID-19, IB has given so-called an leeway and a further extension to all taxpayer for under ITA and also under PITA, where your year end, your accounting period is ended, if I'm not mistaken, December 19, then you will be able to get that extension. The extension of filing of tax return is up to October 2020. Okay, these are PITA tax cycle. So you have tax estimate. Tax estimate is usually similar. You need to file a CP 250 within 3 months from the date of first sales. As I mentioned earlier, your first sales determine your basis period. Okay, when you start having your basis period, then you will calculate your tax estimate, and you will submit your tax estimate within 3 months from the sale of your first sale or first disposal. Okay. Second is tax installment. As tax installment is more on, if in Malaysia, for SITA, for ITA, your tax installment would be paid by 12 months. But for PITA, the installment need to be paid within 10 months. I mean by 10 months, and it has to end by January next year. So basically, if let's say you have uh, you estimate a particular income for that particular year, then you need to start your payment for this example. Commencement of 6 months of basis period is during first sale. Within 6 months, within 3 months, you will file your CP 250, but within 6 months, then you have to commence your first installment. The due date for the installment is on the 15th of each month. Okay, you have revision 6 months and 9 months, similar to ITA. Your annual filing is 7 months. Okay, so your tax estimate for subsequent YAs, beginning of that particular YA basis period, then you need to file your CP, your tax estimate, initial tax estimate 30 days before that beginning. Okay, the tax installment due date is 15, similar, and the installment is 10 equal installment. Okay. Revision the same, 6 and 9 months. Annual filing is 7 months. Okay. Apart from the compliance cycle, duty to keep records is required. I mean, it's a key important things where, as I mentioned earlier, IRB can disallow any expenses if you don't provide the so-called supporting documents. Okay. Duty to keep records, section 34A stipulate that you can have electronic records. You need to keep the records in Malaysia, and you need to have audited accounts, and duration for you to keep the records is 7 years. So if you, I mean, for those expenses that you incurred, the supporting documents, your invoice, your contract need to be readily made available and kept for 7 years. This is the appeal process. I think similar to other ITA. When you receive Form JA, which is your additional assessment, if you do not agree with your additional assessment, then you need to submit your Form Q. Then when you submit your Form Q, then RB would within 1 year will provide, I mean, we submit that to the SCIT. So the SCIT then will issue deciding order whether you continue or not with the so-called appeal. These are the penalties under PITA. For voluntary disclosure, you get, sorry, this is not under PITA, this is under your public ruling. So for voluntary disclosure, you have 10 to 35%. For non-disclosure, if let's say during audit, then it will be 45 to 100%. IRB could penalize you penalty up to 100%. Okay, these are the so-called sections and penalty tax exposure. Okay. Okay, I come to the end of my session. Let me see. For question and answer. Okay. Dr. Salmi.
Yes, here I'm here, Madam Farah.
Okay.
Alright, question and answer. Okay. It seems like we do have one question from Chui Kahong. Madam,
Okay.
is donation and corporate zakat deductible under PITA?
Donation and corporate. Donation, yes. Zakat, no.
Okay. Is there any questions from the floor that we opened the question to the floor? Mungkin if you do have any question you would want to voice it out directly to Madam Fara, also can, or you may put in the chat box. Okay, another one. Okay, the same person, the same student, Chui Kahong. A
Mm-hmm.
PSC may have different oil fields, right? So does the oil fields considered a separate source of income? And can the oil field share deductible expenses? Like, can I deduct expense from oil field A from income from oil field B?
Okay, based on my earlier slides, PSC or under PITA, when we say all fields is, I presume is a PSC, right? PSC, you have a lot of fields under a PSC. Okay, so chargeable person under PITA is the PSC. So the income and expenses under the PSC would be accumulate or set off, would be able to set off each other if it's under the same PSC, except for if that particular field enjoy incentive. As I mentioned earlier, you have PITA incentive, which is your marginal fields, your qualifying projects. Those incentive fields, you need to ring fence. You need to segregate the income and expenses. So if let's say a particular PSC, you do not have any incentive, PITA incentive fields, then you can how can I say, you can set off against the expenses of other fields against your the income of your field, I mean for another fields. Unfortunately, in Malaysia, we don't have shale gas. But under PITA, if it relates to petroleum operations, right, and it's the expenses is not capital in nature, then you can claim. But we do not have specific so-called section or article to cover under shale gas, because kat Malaysia tak ada shale gas. Usually in Canada, we have Canada, we have UK for the shale gas. You're welcome. Any?
Okay, any more questions to our respective speaker here? Maybe you could take this opportunity to ask as many as questions that you would like to at least know about taxation, especially in downstream and upstream, as well as the primary and secondary. So yeah, we are still waiting. Is there any question? Hello? Dr. Saniza or Dr. Rusniza? Okay, no, we have another one from Choi Kahong. How to keep up to date with the tax incentives in petroleum? Do they change frequently?
No. Okay. When you say keep up to date with the tax incentive in petroleum, the tax incentive or PITA incentive was introduced way back in 2010. So There are no other incentive at this juncture, new incentive. The one that was introduced was way back in 2010. Usually for incentive for any changes to the law, you monitor through budget. I mean, what we always do is we will monitor the budget announcement by our Ministry of Finance. Then kita akan, we will look at what are the changes or what are the legislation introduced by the government. I hope I answer your question.
Okay, thank you Madam Choi Kahong. Banyak tanya soalan Choi Kahong ni. Bagus student ni. Yang lain, student lain
Boleh lah join, boleh join Petronas.
You know, you shall take this, you know, chance because since that we brought you the industry, you know, directly to you so that you'll be able to at least, you know, obtain whatever experience or, you know, sharing session from Petronas. And yeah, of course, because sometimes diorang ni malu sikit. Tapi kadang lepas tu kadang baru nak tanya soalan kan. Biasalah tu. Okay, lagi ada tak sesiapa nak tanya soalan? Tak ada? Okay, kalau tak ada soalan, maybe I think like over to you, Intan.
Thank you, Doctor. Can you hear me?
Yeah, sure, we can hear you.
I would like to say thank you to Madam Fara and Petronas for your time and contribution to this academic lecture. It was a very interesting Q&A session. We here at CUIC and on behalf of our director would like to convey her gratitude to Petronas for the tremendous cooperation in sharing your expertise with our students here. I believe this lecture would definitely help the students to have a deeper understanding in taxation and other related subjects. So once again, thank you very much to Madam Fara for your time and expertise that you have agreed to share with our fellow students.
Okay, thank you very much.
Yep, and yeah, of course, that taxation isn't my area at all, but you know, with the explanation that you shared just now, at least I got a picture of what, you know, the differences between maybe upstream and downstream direct tax or primary, secondary, and, you know, especially in petroleum, Petronas pipeline. So once again, thank you very much for the sharing session, Madam Fara. And we do hope that there will be more activities from Petronas and actively engaging with UUM in the future. And let this be our at least a starting point. And we can't wait to you know, come up with a series of activities that would at least you know, for sure benefit our students, especially our final year students prior to their practicum session. Because just for a brief to you and also to our students, fellow students there, that we are at CUIC, we do have a talent development team who would like to you know, at least try our best to do and bring the trainings and workshops which can enhance your skill set, either maybe in the academic or non-academic, particularly to you guys, to final year students, you know, prior to their internship session. So once again, that our talent development division would like to express our appreciation to you, Madam Fara, Associate Dr. Usami, Dr. Saliza, and Dr. Siza, and all fellow students and all staffs who, you know, for attending this session. And once again, thank you very much. And therefore, wait for more from CUIC and keep updated on our Facebook, of course, at Center for Industry, University Industry Collaboration. And so stay tuned, and see you